Why do people sell their crypto? We discuss different scenarios in which people may want to sell their crypto holdings. These are not set in stone possibilities, and you should conduct your research and take caution, but they are worth considering. Welcome to Crypto Inquiry, where we are dedicated to providing you, the investor, and the crypto curious with factual information and topics. Our goal is to keep you informed to make educated and timely decisions and remove the fog of hidden information. Nothing is meant as financial advice, and always do your own research before investing. Here we are building a community to help each other stay informed and make the most of our financial gains. Sometimes a cryptocurrency project and its accompanying token may get off to a terrific start, making lofty promises. The token performs brilliantly and initially gains value, only to gradually lose value over weeks or months. This continuous decline in value might occur when a project just does not make enough development progress. Crypto teams are still working on developing goods. If these items do not materialize, investors will rapidly recognize this. That is why teams place such a premium on transparency and providing regular updates. Without such communication, it is logical to conclude that the team isn't fulfilling its development objectives, which may indicate that you should sell if you have gained a substantial amount. On the other hand, if you have earned a significant profit from your crypto purchase, say the asset has doubled in value from its initial price, then this may be the chance to sell. The project may continue on an upward trajectory with excellent growth, development, and market position, but a trader may desire to take advantage of the available gains. That decision is entirely up to you. If you wish to cash out and relocate your wealth, this might be an excellent option. Otherwise, if you believe the enterprise has good foundations, you may just wait on your assets. You want to reallocate your funds. Whether you make a profit or a loss on a transaction, you may want to explore selling the item to reallocate funds, either to cash in or minimize your losses. Many traders do this because more often than not, their assets are in the red. Putting whatever holdings you have into another venture might help you recover from a loss or profit on another promising asset. But keep in mind that none of this is guaranteed, so you must be certain of your decision. If you believe you've made a good investment, stick with it and don't change your mind. A spate of negative news. The news cycle drives the cryptocurrency market. While this is also true for the stock market, what happens in the media has a considerably greater impact on cryptocurrencies. Given how transparent everything is, and the fact that influencers may have a significant impact, it's not unexpected that cryptocurrencies can fluctuate by double digits in response to the news. Now and again, you'll witness a spate of unfavorable news about a specific product, followed by the token sinking. It's critical to have your finger on the pulse of the market, since this may give you a good idea of where a project is headed. The hold strategy. Holding is an investment strategy that entails purchasing an asset to keep it for an extended period, regardless of market volatility. The phase is an abbreviation for hold on for dear life and a misspelling of the word hold. When markets are volatile, holding may be a viable option. While it is unknown whether holding would pay off for crypto investments, it has traditionally been a go-to strategy for stock traders looking to invest in a bad market. The purpose of holding is to ride out recessions and other market troughs to cash out when the market rebounds. Holding necessitates a lengthy time horizon. Thus, it's typically appropriate for investors who don't need access to their capital for an extended period. If you want to cash out immediately, holding may not be the best strategy for you. Many novice investors will begin their holding using a dollar cost average technique. This means you buy a predetermined amount every day, week, or month, allowing you to buy in at the average price throughout your investment. The recurring investing feature of Public can assist you in implementing the strategy by automating your cryptocurrency investments. Investing in cryptocurrency, like stocks, bonds, mutual funds, and ETFs, is risky because the value of the digital assets changes dramatically. It is important to monitor the market and conduct research before investing. Some investors may want to invest in ETFs that employ future contracts, such as Bitcoin ETFs, rather than directly in a digital currency, to watch the performance of a digital asset over time. Instead of investing directly, ETFs allow you to purchase into a fund that aims to track the growth of a cryptocurrency over time. What is a rug pull? A rug pull is a sort of crypto fraud in which teams pump their project's token before vanishing with the cash, leaving their investors with a worthless asset. Rug pulls occur when dishonest developers build a new crypto token, inflate its price, and then extract as much money as possible from it before leaving it when its price falls to zero. Rug pulls are a sort of exit scam that make use of decentralized financing, or DeFi. Before studying how to recognize a rug pull in crypto and why they occur, it is useful to understand the three sorts of rug pulls. Types of rug pulls. In cryptocurrency, there are three sorts of rug pulls: liquidity stealing, limit selling orders, and dumping. When token creators remove all coins from the liquidity pool, this is referred to as liquidity stealing. This destroys all of the value that investors have infused into the currency, pushing its price to zero. These liquidity pulls are most common in DeFi situations. The most typical exit scam is a DeFi rug pull. Limiting sell orders is a sneaky approach for a bad developer to cheat investors. In this case, the developer programs the tokens so that they are the only ones who can sell them. Creators then wait for retail investors to make investments in their new cryptocurrency using matched currencies. Matched currencies are two currencies that have been paired for trading purposes, with one being traded against the other. When there is sufficient positive price activity, they sell their holdings, leaving behind a worthless token. Dumping occurs when developers sell their huge number of tokens rapidly. This lowers the coin's value and leaves surviving investors with useless tokens. Dumping frequently happens after a lot of advertising on social media networks. The resultant price increase and sell-off are referred to as a pump and dump scheme. Dumping is more ethically ambiguous than other DeFi rug pull schemes. It is not immoral for crypto developers to purchase and sell their currency in general. When it concerns DeFi cryptocurrency rug pulling, dumping refers to how much and how quickly a coin is dumped. How to avoid a rug pull in crypto. To protect themselves from rug pulls, investors can look for various evidence signals, such as the liquidity not being secured and no external audit being performed. Unknown or anonymous developers. Investors should take into account the credibility of the persons behind new cryptocurrency initiatives. Are the creators and promoters well known in the crypto world? How long have they been in business? Do they still look credible and capable of delivering on their claims if the development team has been doxxed but isn't publicly known? Investors should be wary of fresh, readily fabricated social media accounts and identities. The white paper, website, and other media quality of the initiative should provide hints regarding its general validity. The presence of anonymous project creators might be a warning indicator. While Satoshi Nakamoto, the world's first and largest cryptocurrency creator, remains unidentified to this day, times are changing. No liquidity locked. One of the simplest methods to tell the difference between a scam coin and a legal cryptocurrency is to see if the currency is liquidity locked. With no liquidity lock in place on the token supply, nothing prevents the project developers from stealing the whole liquidity. Liquidity is ensured through time-locked smart contracts, which should endure 3 to 5 years after the token's first issuance. While developers can write their time locks, third-party lockers can give more security. Investors should also look at how much of the liquidity pool has been locked up. A lock is only useful in proportion to the quantity of liquidity it protects. This amount, known as total value locked, TVL, should be between 80% and 100%. Limits on sell orders. A malicious actor can program a token to limit the ability of certain investors to sell, but not others. These selling limits are typical of a sham project. Because selling limitations are hidden in code, determining if there is a fraudulent behavior can be difficult. One method to test this is to buy a small quantity of the new coin and then immediately try to sell it. If there are difficulties in dumping what was just acquired, the endeavor is most certainly a hoax. That's a wrap for this video. Let us know in the comments below if you think hold is a good strategy. If you enjoyed this video, give this a big thumbs up, and do not forget to subscribe to our channel if you want to see more videos like these. See you next time.